What does it take to amass Mr. Reed's $8 million fortune? It might not be as hard as you'd think if you live as long and as frugally as he did.
Did you guys hear about the janitor who amassed an $8 million fortune? What if we could do the same and see similar results? Buckle up, because today we are revealing his secrets. Hey friends, welcome back to the channel. If you're new here, I'm Bilal and I've spent the last 10 years working in finance in Hong Kong and Singapore. On this channel, we decode the mysteries of valuation and investing. Whether you're an experienced professional or starting your finance journey, we've got something that will enlighten you. If you find this content helpful, don't forget to like our videos and subscribe to the channel. Now, let's get into today's story. Born in 1921, Ronald Reed worked at a gas station for 25 years and later as a janitor. He lived a simple life and drove a second-hand car, but beneath the surface, he was a master investor. Ronald built an $8 million fortune by investing in blue-chip stocks like P&G, General Electric, and IBM. His secret? Pick high-quality businesses, invest at reasonable valuations, hold for the long term, and rely on the power of compound interest. So let's break this down and try to understand Ronald's investing strategy and, more importantly, how we can apply it for ourselves. Number one, Ronald was a long-term investor. If you aren't a professional investor and if you attempt day trading or investing for the short term, most likely you will lose money in the long run. Trading is a zero-sum game and it's very difficult to beat the professionals. Professionals have superior information advantage, they have tons of analysts working for them, and they have access to high-frequency trading algorithms. How do you compete with that? Ronald harnessed the power of compound interest. This means the returns and dividends his stocks earned each year were reinvested and compounded over the years. Check out this compounding calculator, which shows you the financial benefits of compounding. I've logged on to moneygeek.com and there's a really cool compound interest calculator on this website. Now, for Ronald Reed to amass $8 million, assuming that he was able to contribute $300 every month to his investment fund, and let's assume that he did this over 55 years. As you can see that after 55 years, the cash that he would have collected had he not invested would have been around $200,000. So this is just pure cash accumulating year on year. But Ronald was very clever and he put his money in blue chip stocks. And over the last 55 years, on average, the S&P was giving around 10%. So I've used 10% as a rough approximation as to the investment return that Ronald would have gotten over the last 55 years. And as you can see, that he would have amassed over $8 million. Let's do another example and show you what it would be like if you had to invest. So let's say if you had $10,000 in saving today, and say that if you could put $500 a month, without any return, you would amass cash of $340,000. But you are smart and you put your money in the stock market over a very long period and you let your money stay and sit there and compound over the long term. If we are conservative, let's put an 8% return. You would amass $6.7 million by the time you retire. But 8% is what you would get if you put your money with an investment fund or with a financial advisor. And remember, they're taking 1%. So if you invest yourself, you will save the 1%. So in fact, you would get 9% return. And it goes up from $6.5 million to $10.5 million. That 1% that you're saving by investing yourself is giving you $4.5 million more worth of cash. So it makes sense to invest for the long term and to keep your money in the stock markets and to do it yourself and pick high quality companies. Number 3, Ronald picked high quality businesses that were run by competent management. The businesses he picked were generating stable positive cash flows, had durable competitive advantages, and strong balance sheets. And lastly, and more importantly, Ronald invested at reasonable valuations. No matter how good a business is, if you invest at a high valuation, you will make subpar returns. Good investors are like professional poker players. Just like how poker players fold most hands and only play a good few hands, similarly, a good investor will say no to most stocks and only choose the best few once he's confident what he's buying is at a reasonable valuation and there is a margin of safety. Margin of safety is a difference between the intrinsic value of a share and what you actually pay. So when you invest, make sure to have that margin of safety. You know, I'm disappointed how most investment courses in school teach investing. They say pick a company, study its financials, build a DCF model, calculate the intrinsic value, and lastly, compare that intrinsic value to the stock price to determine if it's over or undervalued. You know, this is absolutely ridiculous because it doesn't start with what you think about the stock and your assumptions in the DCF. It starts with what you think the market thinks. I explained this concept in more details in another video. The link will be here or in the show notes below. Thanks for watching, and don't forget to like and subscribe to the channel for more valuation and investing content.